Welcome to the pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. Singapore just triggered a $1 billion emergency shield to suppress utility costs, and if you hold local industrial real estate investment trusts, this is the exact moment your dividend yield comes under structural threat. The government has stepped in to help with household light bills, but your industrial landlord is still paying full price. Today, we are going to break down exactly why this shield exposes your distributions and which of your assets will survive the margin squeeze that is already mathematically locked into the system. This is the $1 billion warning for retirees relying on these dividends. Let us move to the structural reasons why this matters. On your screen right now is the core reason why Singapore's energy shield exposes your real estate investment trust dividends. The $1 billion payout making the news is not a windfall for the market. Instead, it is the pre-funding of a severe utility shock that has not yet appeared on a single balance sheet across the SGX industrial sector. The central question for your portfolio right now is not whether global energy prices are rising or falling today. The real question is which of your assets will survive the margin squeeze that is already mathematically locked into the system and will only become visible 2 quarters from now. This is about understanding the mechanics of cost transmission before the broader retail market wakes up to the reality of the impending distribution cuts. Let us look at what the retail market is missing. What you are looking at is the forensic gap that the retail market has completely failed to price in. When you read the headlines about energy subsidies and temporary relief, it is easy to assume that the commercial sector is receiving the same protective umbrella. But that assumption is a massive blind spot. The retail crowd is seeing the headline and breathing a sigh of relief, while the actual underlying utility costs for these commercial assets are quietly compounding. Institutional money is already calculating exactly how much cash flow will be erased from commercial real estate earnings. By the time this forensic gap closes and the broader market realizes what is happening, the repricing will have already occurred. We need to look deeper into the data to see exactly how this gap formed. Before we dig into the numbers, let us talk about why we take this forensic approach. You are not here for hype or the latest stock tips. You are here because you demand the data and because you are the kind of investor who checks the gearing ratio twice before committing a single dollar. But there is an algorithm problem. Independent analysis like this is entirely invisible to the machine unless you subscribe. Every forensic investor who reads this deep dive without subscribing simply disappears from the signal. We have to actively tell the system that real data-driven analysis has value. Let us talk about how you can help fix that. If this analysis has ever helped you identify a hidden risk in your portfolio or calculate a true margin of safety, I am asking you to subscribe for free and share it with one person who needs to hear it. Do not do it for me. Do it to tell the algorithm that data-driven forensic SGX analysis deserves a permanent seat at the table alongside all the market noise. When you subscribe, you ensure that this kind of unvarnished truth keeps cutting through the algorithm. Now that we are clear on the mission, let us get into the exact storm that is brewing for your dividends. We are entering section 1, and this is about the storm that has already happened, even if you cannot see it in the unit prices yet. The Middle East conflict systematically squeezed the Strait of Hormuz, and physical dated Brent reached near $150 per barrel at the peak of the crisis on April 7th. By April 8th, a ceasefire announcement had pulled spot Brent back sharply to approximately $93 to $94 per barrel, a drop of over 14% in a single session. Most retail investors watching that headline number will conclude the energy crisis is over. That conclusion is the absolute most dangerous misread of the current macro cycle, and I will show you exactly why. The reason the spot price movement is almost irrelevant to your dividend stream lies in the tariff lag mechanism. The SP group does not set the electricity tariff based on where Brent crude is trading today. The Q2 tariff for 2026 was set at 29.72 cents per kilowatt hour, including GST. That figure was calculated using natural gas prices averaged from January 1st to March 15. It only partially captures the Hormuz-driven price spike. The Energy Market Authority has explicitly flagged that further and potentially sharper increases are expected in Q3 and Q4, as the full effect flows through. The balance sheet pain arrives months after the actual price shock. Let us see how this impacts different types of properties. The reality is that the ceasefire changes absolutely nothing for your real estate investments. The Q3 tariff calculation window opened on April 1st, which means the Hormuz damage is already averaged in, regardless of where spot crude closes this week. Your HDB flat is protected by the $1 billion household subsidy. But that logistics warehouse in Jurong, it has zero protection. It has full commercial exposure to the Q3 and Q4 tariff spike. The 6-month lag in this adjustment mechanism is the quietest and most dangerous part of this entire cycle. Let us formalize this with my personal insight on the situation. Here is my direct insight on this mechanism. The psychological gap between what institutional money is pricing and what the retail market feels is currently at its widest point. The state has ring-fenced the consumer, but it has left the commercial landlord fully exposed to the elements. The dividend you rely on to fund your retirement is standing directly in the path of a cost wave that was locked in months ago. That wave cannot be recalled by any diplomatic announcement or temporary ceasefire. The cost is already in the system and it is coming for your yield. Now, let us translate this into actual wallet impact. Moving into section 2, we have to look at the wallet consequence. To understand how a tariff lag translates into a localized margin collapse, think about the household scale. When the energy tariff surges, the monthly utility bill for a 4-room flat might shift upward by $30 to $50. Now apply that same proportional increase to a commercial scale like a massive logistics warehouse. We are talking about millions of dollars annually. This reveals the shield gap. The energy subsidy protects your flat, but it offers zero protection to the net property income of the industrial asset sitting in your brokerage account right now. Let us look at how this changes your investment calculus. This macro reality forces a completely different CPF and SRS calculus. Your CPF special account offers a guaranteed sovereign-grade return. It absorbs inflation shocks with zero capital risk, acting as a true sanctuary. Now compare that to a gross lease trust yielding 5.2%. If the incoming Q3 tariff shaves 80 basis points off that distribution, your net yield falls to 4.4%. You are taking on equity risk, debt refinancing risk, and geopolitical energy risk for a measly 40 basis point premium over a guaranteed rate. The math simply does not justify the exposure. We need to look at the one tool that can protect you. The most direct wallet consequence depends entirely on how lease agreements are structured, specifically gross lease versus triple net. With a gross lease, the landlord pays the utilities. As the SP group bill spikes, net property income collapses, and the distribution is inevitably cut. Conversely, triple net leases are structurally fortified. The tenant pays the utilities directly, meaning the energy shock passes entirely to the occupier. Your distribution is shielded. Understanding this lease architecture is the single only forensic tool that truly protects your retirement cash flow from the incoming grid adjustments. Let us look at the secondary effects of this structure. Here is another critical insight that retail investors are missing. The second-order effect is the debt servicing cascade. When utility bills compress net property income, the overall valuation of the asset takes a hit at the next appraisal. That valuation drop pushes the gearing ratio higher without the trust taking on a single dollar of new debt. A trust operating with an interest coverage ratio of 2.5 times faces a binary choice: slash the distribution or risk a technical covenant breach. You are watching the fortress walls of the balance sheet weaken in real time. Let us verify this with the hard data. Welcome to Section 3, the data proof. Looking at the macro evidence dashboard, the Brent crude spot reversal does not cancel out the locked-in tariff impact. The Q2 SP Group tariff of 29.72 cents only partially captures the Hormuz spike, meaning the worst is still ahead for Q3 and Q4. The benchmark interest coverage ratio has dropped to 3.8 times from 4.6 times a year ago, showing a weakening buffer right as we enter this tariff shock window. With a logistics gross lease ratio of 42% and zero industrial power subsidies, there is full cost transfer to the commercial landlord. This structural delay has created a dangerous illusion of safety. Let us visualize how this works. Think of Singapore's power grid using the water hose analogy. When there is a pressure drop in Hormuz, it takes time to travel through the system. The gas prices from January through March are now priced into the Q3 tariff. By the time that impact reaches the Jurong tap, commercial balance sheets will take the hit in Q3 and Q4. The ceasefire buys diplomatic time, but it does not rewind the averaging mechanism. The government deployed the $1 billion relief because their forward models already show exactly what Q3 and Q4 will look like. We need to map out the strategic picture for the sectors. In Section 4, we examine the strategic picture through the SGX Sector Watch. Lease architecture is now the primary determinant of distribution survival, not yield, sector, or management quality. Industrial gross leases are pressured because of utility cost absorption, and you must watch for an interest coverage ratio below 3.5 times. Industrial triple net leases are supported due to direct cost pass-through. Retail heartland malls are neutral based on rent stability, but watch for gearing over 38%. Data centers are on watch due to high energy intensity and expiring power contracts. Let us look at the possible scenarios. Here is our macro scenario matrix. The bull case assumes Hormuz clears and gas normalizes before the Q3 window closes, which is a low probability. Our base case, which has a high probability, anticipates sustained Q3 and Q4 tariff hikes as the Energy Market Authority flagged. The primary impact will be gross lease dividends getting cut, with minor gearing breaches as a second-order effect. The bear case is the ceasefire collapsing and oil respiking, leading to mass interest coverage ratio downgrades and a structural equity rotation. Given these scenarios, we must run a stress test on your portfolio. Before allocating another dollar, you must run this stress test. This brings us to forensic question 1. Can your gross lease industrial holding absorb a 30% utility spike without breaching the 4 times interest coverage ratio? Multi-tenanted buildings where landlords bear central air conditioning and common area lighting face the absolute sharpest margin compression. If they cannot absorb this spike, a distribution cut becomes the only mathematical option available to management. You have to audit the lease types rigorously. Let us move to the second question. Forensic question 2 requires you to audit your blue chips. Look at their disclosures and ask, how much domestic operational expenditure is tied directly to the unhedged local power grid? You need to check if they are operating on fixed-rate energy contracts or if they are floating on the spot market. If they are floating on spot, their forward earnings guidance is already partially obsolete. You cannot rely on past yield data if the underlying cost structure is currently floating into a massive tariff spike. Let us look at the third and final question. We are at section 5, the Singapore Investor Playbook. My personal forensic floor remains 3.2%. A macro shock does not change the floor. It just changes how many assets can still clear it. You need to audit the direct exposure, which is the total gross leasable area where the sponsor is legally obligated to absorb utility costs. Then, check the buffer headroom, which is the net property income generated purely from base rent increases. Finally, identify the shock threshold, the exact dollar point where the utility bill overtakes organic growth and forces a distribution dip. Let us apply this to a specific asset type. When we apply this to flatted factories, the shock threshold is dangerously low. A mere 15% tariff rise can completely erase all positive rental reversions for the entire year in standard flatted factory portfolios. And remember the Energy Market Authority warning. Q3 and Q4 increases have been flagged as potentially sharper than Q2. This means a 15% increase is a conservative scenario, not an extreme one. The buffer simply runs out before the energy shock even reaches its peak. If you are building a portfolio, you need a specific approach. If you are still building your portfolio, the rule is to audit, do not accumulate. This is a period for structural review, not aggressive buying. You must aggressively watch lease conversions. Monitor whether these trusts are converting gross leases to triple net leases as they expire. Every successful conversion improves the quality of your future distribution. Beware the slow bleed. Assets failing to convert will slowly bleed net asset value as basic electricity resets at a permanently higher plateau. What if you are already relying on these payouts? If you are already drawing from SRS or living off these distributions, stability must entirely replace ambition. The gap between an engineered yield and genuine cash flow becomes painfully obvious during an energy shock. First, identify exactly which of your holdings carry the utility burden. Second, measure them against the guaranteed CPF sanctuary rate. Third, make the forensic call right now before Q3 earnings confirm what the tariff mechanism has already decided. You cannot afford to wait 2 quarters to find out if your sponsor hedged their power contracts. Let us look at the brutal reality of a cut. This is the ultimate wallet consequence. If your industrial asset cuts its distribution by 30% just to pay a surging SP Group gas bill in Q3, you face a brutal double bind. Will your SRS account still generate enough absolute cash flow to cover your own inflated household utility costs? The distribution cut will happen precisely when your own household expenses are still elevated, destroying your purchasing power exactly when you can least afford it. We have reached the final stage of our analysis. Welcome to Section 6, the forensic verdict. The $1 billion shield was never a celebration of fiscal strength. It was a preemptive strike against the margin collapse already mathematically locked into the Q3 and Q4 tariff windows. The ceasefire illusion is that spot crude falling 14% in one session fixed everything. It did not pull back a single cent of gas pricing already averaged into the forward tariff. The retail market has not priced this gap, but make no mistake, the institutional money already has. Let us wrap up with the final takeaway. The absolute bottom line is that you must stop reading the spot price and start auditing the lease. The SP Group tariff operates on a 6-month lag. Today's diplomatic headlines cannot undo the costs already inside the averaging window. The distribution cut will not arrive as a bold headline. It will arrive quietly in a Q3 earnings release, framed simply as a temporary operational adjustment, long after institutional money has safely repositioned. For the full data tables mapping specific gross lease exposures across the local industrial sector, the complete breakdown is currently under the 7-day embargo window on the Substack. For 0-day access to these forensic thesis shifts, join Iggy's Elite Investors. The link is right there in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.